In the years after the financial crisis, one writer compared Larry Fink to the Wizard of Oz, the man behind the curtain. A senior banker went further and called BlackRock the Blackwater of finance, almost a shadow government. Those lines are opinions, color, not a Fed finding. But the weekend that made the myth feel real was concrete. March 2008. Bear Stearns is collapsing, JP Morgan is circling a rescue, and nobody wants the hard part of the deal, roughly $30 billion of mortgage desk assets that the market is pricing like poison. The government's problem is simple to say and brutal to solve. Someone has to value that junk, hold it, and sell it carefully, without setting the rest of the market on fire. The firm pulled into the center isn't a household bank. It's BlackRock, huge on Wall Street, invisible to most Americans. So how does a bond and risk shop become Washington's cleanup crew? And what did it actually control? The answer starts with a scar. In 1986, Larry Fink's mortgage desk at First Boston blows up after a wrong-way rates bet, a loss on the order of $100 million. The lesson sticks. If you can't see the risk in the book can kill you. In 1988, Fink and his partners found the firm that becomes BlackRock. The DNA is fixed income and risk systems, the platform that grows into BlackRock Solutions and Aladdin, software that can see portfolio risk when everyone else is flying blind. By the end of 2008, BlackRock still manages about $1.3 trillion. Big. Not yet the default owner of everything. Aladdin, the firm says, is already monitoring more than $7 trillion in positions, monitoring, not owning. And Larry Fink has another asset, trust. In the crisis years, press accounts place him in the room with CEOs and officials, including contacts with Timothy Geithner and Hank Paulson. Treat that as reported color. What matters is the combination, capability and access. When the Fed needed someone who could price panic junk at 3 a.m, BlackRock was callable. March 15th and 16th, 2008, the Federal Reserve Board authorizes emergency lending under Section 13(3). JP Morgan needs government support for Bear's hard-to-sell book. JP Morgan hires BlackRock to help value the assets. Then, the New York Fed puts BlackRock on the job that lasts for years, investment manager for the vehicle that will hold them. On June 26th, Maiden Lane LLC closes. The New York Fed extends a senior loan of about $28.8 billion. JP Morgan puts in a subordinated slice of roughly $1.15 billion. Together, they buy about $30 billion fair value of Bear's mortgage desk assets, valued as of March 14th. Maiden Lane is a Fed-backed special purpose company. It holds the junk so the rescue can close. BlackRock runs the portfolio as an agent of the New York Fed under the Investment Support Office, not as a free agent and not as the lender. The mandate in plain English: get the Fed repaid with interest. Sell carefully. Don't disturb markets. That is the first turning point. The Fed lent and controlled. BlackRock managed under contract. Then the fire gets bigger. In July 2008, AIG hires BlackRock to model its multi-sector CDO and credit default swap exposure, a giant stack of complex paper. In September, Lehman fails. AIG goes into crisis. According to Vanity Fair and BlackRock executive Chuck Halleck, for a time there are 2 BlackRock teams inside AIG, one working for AIG management, one for the Fed. And initially, neither team is told about the other. Conflict optics don't get uglier than that. The cash drain is a death spiral you can explain in one breath. By October 24th, AIG has already posted about $30.25 billion in collateral. Counterparties are demanding another $4.2 billion. As prices fall, the marks demand more cash. More cash weakens the firm. The spiral tightens. In early October, the New York Fed asks BlackRock for confidential advice on structuring a fix. That path becomes Maiden Lane 3. By November and December, 2 more vehicles close. Maiden Lane 2 takes AIG's securities lending mortgage bonds. The Fed's loan is about $19.5 billion. The portfolio is roughly $20 to $21 billion at market value. nearly $40 billion in face amount. Closes December 12th. BlackRock is the investment manager. Maiden Lane 3 buys multi-sector CDOs so AIG's financial products unit can tear up related credit default swaps. The Fed's loan is about $24.3 billion. AIG puts in about $5 billion of equity. Assets of roughly $29 to $30 billion fair value, more than $60 billion face. The investment management agreement is dated November 25th. Again, BlackRock. Press later reports other government-adjacent valuation work, including a Citigroup book on the order of $300 billion. Soft secondary color. What is hard is this: the same firm keeps getting the hardest portfolios. By spring 2009, the question isn't technical anymore, it's political. The New York Times, the Christian Science Monitor, and members of Congress dig into no-bid contracts, fees, and conflicts. Representative Marcy Kaptur asks how many no-bid deals the Fed has signed with BlackRock. Senator Claire McCaskill asks why BlackRock is suddenly everywhere, involved in everything related to sorting out the financial mess. Fed Chair Ben Bernanke's answer, as reported, is blunt. Several contracts were signed because of the exigencies of time. Fee reality for the viewer. American Banker reports at least about $71 million in first-year Maiden Lane fees, roughly $45 million on the Bear book, about $25.5 on the AIG vehicles, with multi-year upside as the portfolios shrink. Vanity Fair later estimates something in the neighborhood of $200 million over the first 3 years on the Bear and AIG work. Treat that as an estimate. BlackRock earned management fees. It did not pocket Maiden Lane profits. Hold both truths. Few firms could value and liquidate these books at crisis speed. Scarcity is the plot. And early opacity did fuel the myth that something darker was happening behind the curtain. From 2009 through 2012, BlackRock liquidates under New York Fed guidelines: slow sales, careful exits. In early 2012, the Maiden Lane 2 loan is repaid. Public reporting cites a net gain on the order of $2.8 billion. On June 14, 2012, the New York Fed announces that the Maiden Lane 1 and Maiden Lane 3 loans are fully repaid with interest. William Dudley calls it a major milestone. The last remaining Bear and AIG debts owed to the bank are retired. Public figures later put Maiden Lane 3's net gain around $6.6 billion and Maiden Lane 1 around $2.5. Reframe carefully. Taxpayers' loans on these facilities were repaid, with reported net gains. That undercuts the story that BlackRock looted the bailout. It does not mean the crisis was costless, and it does not mean BlackRock wasn't unusually central. One coda. In June 2009, while the scrutiny is peaking, BlackRock announces it will buy Barclays Global Investors and the iShares franchise. Crisis credibility plus a scale jump toward the giant the world knows today. Years later, governments would call again. That's another story. BlackRock didn't become the Fed. It became the firm the Fed trusted to clean the garage. And that trust, under emergency rules without a crowd of competitors, is exactly why the secret weapon story never died.